as long as silver stays above 71, you're solid. $6 in silver is a reasonable and sizable move. It certainly, again, doesn't qualify as a correction. We have seen no technical evidence that that is occurring. And until we do, I think both precious metals, gold and silver, are running on all 8 out of 8 cylinders, although most are 12 and I drive an electric. But we don't believe that when we see these minute sell-offs that a real pivot has taken place in which market sentiment has moved from bullish to bearish. Traders entering the market, buying that dip and moving it back up. Again, in a normal scenario, even in a normal bullish scenario, it's not unusual for there to be a correction of 23, 38, even 50% and still look at it as bullish. People are buying the dip. That is an advertisement. Oh, we missed this.
Silver is volatile. It's currently, testing that mid 75 range on spot. Let's widen the lens, though. I mean, it's rallied roughly 150% last year. When you look at this pullback, does it kind of register as a, structural damage? Is it simply just the market digesting a massive move?
Personally, I am surprised that we haven't seen any kind of a major correction in quite some time. The fact that when we look at gold, for example, on the 26th of December, it hit its all-time record high close. This is basis the most active February futures contract, 45.47. And the fact that it came down to a low of about 43.13, that, traders, is not by any definition a correction. It's a slight pullback. We can call it a number of things, but one thing that would be inappropriate, in my opinion, is to call this little tiny dip in gold a correction. Simply put, a correction is typically a sell-off of a 23% or greater. It can be as deep as 61.8% in a bull market, recover, and market technicians look at that as a deep but respectable correction. They don't look at it as a pivot from bullish to bearish.
A lot of investors panic at red candles without realizing how small they really are in context. As Gary Wagner points out here, a 150% annual rally changes the math of what a pullback even means, and a dip from 4,547 to 4,313 in gold doesn't meet any textbook definition of a correction. Historically, bull markets often absorb 20% to 30% drawdowns without breaking trend, and we haven't seen anything close to that. The bigger risk for portfolios right now isn't downside damage, it's misreading consolidation as weakness and exiting too early. Most long-term commodity upcycles shake out impatient capital first. What Gary Wagner hints at next reframes why volatility itself may be the fuel, not the threat.
We have seen no technical evidence that that is occurring. And until we do, I think both precious metals, gold and silver, are running on all 8 out of 8 cylinders, although most are 12 and I drive an electric, but nonetheless, it's driving at full steam.
Yeah. So, I mean, last time we were on, I was watching it this morning, you warned that, silver had gone parabolic and that a hard correction would be very normal, even healthy, as long as support held. I mean, you take a look at it, what we're seeing on this correction. Is this what you were kind of warning about? Is it turning into something more than mean reversion?
Not really. If you see the move, and I'm trying to put it so that we're looking at all of last year, which won't be that difficult. We've seen this market really move considerably.
Yeah.
Figuring that it was trading at the lows at about $30, traded to a high of over $80. This is based on the most active March contract. There has been really no correction. The move itself from the former high on the 26th of December, $76, it comes down to $70.
Parabolic charts scare people, but context matters more than emotion. Gary Wagner emphasizes that a move from $30 to over $80 resets expectations, and a pullback from $76 to $70 is statistically minor within that trend. In prior commodity bull cycles, 10% to 15% retracements were routine pauses, not signals to abandon positions. For everyday investors, the danger isn't volatility, it's confusing mean reversion with trend reversal. Silver hasn't broken structure, momentum, or long-term support. The smarter question isn't, is this falling? But is the market still paying higher prices over time? What Gary Wagner says next clarifies why support levels matter more than headlines.
Yeah.
While $6 in silver is a reasonable and sizable move, it certainly, again, doesn't qualify as a correction. Because when we look at the totality of the move from 30 to 80, $6 back is not any kind of a viable percentage in what we look for in terms of a real correction. Simply put, we have not seen either gold or silver have a realistic correction pretty much all of last year, and this year's too early to tell. But again, when we are pairing these precious metals against fiat currencies, in this case against the US dollar, the recent moves I know that came in gold took gold to all-time record highs across the board in almost every currency. Not just the euro, not just the dollar, but pretty much all of the currencies. And that is a strength statement, meaning regardless of what currency you pair it against, you're pairing paper against an asset that has for thousands of years had real intrinsic value. Mm-hmm. People more and more are not looking at currencies as having intrinsic value. And that, to me, is the key.
Yeah, fair point. And so, I mean, if we, spend the rest of this rebalancing week chopping between 74, 78, you view that as accumulation, right? I mean, what's the danger zone, the level where you'd say this has gone from rotation into kind of real technical damage?
The quiet part here is that gold's strength isn't dollar weakness. It's currency skepticism everywhere. As Gary Wagner explains, gold making record highs across nearly all currencies signals a global confidence issue, not a US-only story. IMF data shows over 40% of central banks increased gold reserves last year, while fiat purchasing power continues to erode. This reframes silver's chop as accumulation, not instability. When investors stop trusting paper promises, metals stop behaving like trades and start acting like insurance. That shift rarely reverses quickly. What Gary Wagner flags next exposes the line where confidence finally breaks and where risk actually begins.
Basis the March contract below 70. That's these dips. I'll blow this up just a little bit. That's these lows that came in at the end of the year. Then it popped up and made its all-time record high. Tuesday, January the 6th. Yes, it's come down for the last 2 days. But as long as silver stays above, call it $71 if I want to kind of tune in, we are not looking at any change in terms of whether or not silver is in a bullish or bearish trend. Mm-hmm. What we can say is we've lacked any kind of healthy correction. And so I always believe the caveat has got to be buyers beware, because at any moment we could see a real correction take place if major players begin to liquidate long positions. I am still accumulating. I am still advising in terms of our trade. 95% of them initiate a long position rather than going short. Short, to me, in the futures markets, in these metals at this particular time, is asking my clients to stand on a train track with a train barreling down the track at 80 miles an hour and kind of saying that it will stop. Mm-hmm. Well, it may and it may not. The point is the strength right now in gold and silver is really maxed out.
Support levels are where emotion meets discipline, and that's where most investors fail. Gary Wagner makes it clear that as long as silver holds above $71, the bullish structure remains intact despite daily noise. CFTC positioning data already shows heavy long exposure, which explains the caution. Crowded trades can unwind fast. But shorting into peak momentum historically produces asymmetrical losses, especially during macro-driven metal cycles. The real risk is mistiming exposure, not owning the asset. Strong trends rarely end quietly. They exhaust participants first. What Gary Wagner warns about next is how that exhaustion eventually reveals itself in price action.
There's huge momentum, very few, if any, real corrections. And so people are buying the dip. When we see the market sell off a couple of dollars, that is an advertisement. Oh, we missed this. We can continue to accumulate. I recommend,
Yeah, no, that's a good point, because I mean, I spoke this morning with a former executive at a major bullion bank, kind of an insider in this space, and his view was that, you know, the index rebalancing is typically short-term noise, like you said, and this kind of mechanical selling often attracts buyers willing to absorb supply. So, I mean, Gary, when you look at today's price action holding around 75, 60, I mean, do you see signs of that absorption? Are bids showing up to meet this rebalancing flow? I mean, it feels like people are buying it.
I see gold and silver, because they're both acting very similar in a similar manner, trading near the recent all-time records, selling off slightly, traders entering the market, buying that dip and moving it back up. Again, in a normal scenario, even in a normal bullish scenario, it's not unusual for there to be a correction of 23, 38, even 50%, and still look at it as bullish.
This is where momentum quietly replaces fear, even as headlines scream volatility. As Gary Wagner points out here, shallow pullbacks combined with steady buying often signal institutional absorption, not retail speculation, and that matters more than daily price noise. Historically, index rebalancing weeks account for short-term pressure, but data from CME positioning shows net long exposure rebuilding quickly after similar events. For investors, the key risk is assuming smooth trends continue forever. Bull markets remain bullish even after 30% retracements, but timing entries still matters. This is less about chasing dips and more about understanding who is stepping in and why. What Gary Wagner explains next reframes this buying as a structural behavior, not emotional optimism.
In other words, we don't believe that when we see these minute sell-offs, that a real pivot has taken place in which market sentiment has moved from bullish to bearish. And we've got so many fundamental factors going on in the world right now. Recent action by the United States against Venezuela, that one kind of, at least to me, came out of the blue. I'm not privy to inside information, but that is the kind of behavior that puts countries on edge, because they don't know what a next move might be and who that might be against.
Small price dips distract investors from much larger geopolitical signals hiding in plain sight. As Gary Wagner highlights here, market sentiment doesn't flip on minor sell-offs. It shifts when unexpected state actions disrupt global stability, and history backs that up. Events like the 2003 Iraq invasion or the 2014 Crimea annexation triggered capital flows into hard assets long before equities reacted. The Venezuela move adds uncertainty without clear economic resolution, which quietly supports metals as risk hedges. For portfolios, this isn't about panic buying. It's about recognizing when uncertainty is structural, not cyclical. What Gary Wagner points to next shows why markets stay calm right before uncertainty is repriced.
Granted, the guy they grabbed was a brutal dictator, according to everything I've read. But to go into a sovereign country and grab someone because of that is not behavior from a mature superpower that we have seen in any occasion in the recent past, and nothing like this has really happened since any of the major wars or even Korea or Vietnam. It's a different time,
Yeah,
and
definitely.
people are on edge because of it.
Yeah, yeah. And I mean, you see it. I mean, some of the volatility. I mean, looking at gold, silver's obviously volatile. Gold, I mean, looking at it today, it feels like it's a kind of a steady anchor. It's hovering right around that 44.50, essentially flat on the day, despite the noise that you're talking about, in particularly in the rest of the complex. You heard it. We're off next week. And I mean, as we head into next week, what does gold stability tell you? I mean, if the leader's refusing to drop, does that put a floor under silver? And, again, if the Fed turns more hawkish next week and pushes back on cuts, is there a trap door here? Are we one hawkish comment away from a $200 drop?
Gold's calm is telling a very different story than the news cycle suggests. As Gary Wagner notes early here, when geopolitical shock doesn't trigger selling, it often signals deep conviction beneath the surface. During past crises, like 2019 trade tensions, gold stabilized first while equities whipsawed later. For investors, gold holding near 4,450, while silver swings suggest capital is hedging risk, not fleeing markets. The real trap isn't a hawkish soundbite, it's assuming policy talk outweighs capital behavior. Stability at highs is rarely weakness. What Gary Wagner emphasizes next clarifies why only real policy action changes trends.
Personally, I don't see it. I think a big drop is going to be implemented by a major fundamental shift, economic policy by the Fed, not cutting rates when the expectations were high. I don't think it's going to be a statement by a political entity that moves this market, bullish or bearish to a great extent. It is action by superpowers that no one was expecting, whether it's Russia, China, or the US. That will have a dramatic effect. But I think that we're not seeing the international and economic boat being rocked to any great extent.
Yeah.
And that's a good thing. But we do know that the metals tend to run in times of uncertainty. We do have uncertainty in terms of action, but I don't see it being a political statement having that effect.
Yeah, yeah. I mean, if gold sits here holding, 44.50, that handle through next week, I mean, are we setting up for a run towards 46.50 later this month? I mean, what are your thoughts?
Well, I see 45.50 is a very achievable level. We're at 44.60. And in terms of the numbers that I'm looking at throughout the year, I would not be surprised if we saw 47 and 48 by the second quarter of this year, if not sooner.
Markets don't reprice on words. They reprice on broken expectations. As Gary Wagner explains, the real risk lies in policy divergence, especially if the Fed fails to deliver cuts already priced into futures markets. Fed funds probabilities have swung more than 20% in recent months, yet gold hasn't cracked, which is telling. That resilience suggests investors are preparing for policy error, not reacting to headlines. For long-term portfolios, this supports higher upside targets while keeping downside anchored unless liquidity conditions tighten sharply. Momentum survives until policy reality intervenes. What Gary Wagner signals next hints at why timing the move matters less than understanding its source.
I'm trying to stay away. I'm good at calling prices, not very good at calling time parameters to get there, because the pace at which we have seen these metals move, especially with the lack of any realistic correction, has just kept this bullish momentum going. And there's that FOMO from regular speculators that watch the market really go supersonic and not take advantage of it, which is why I tell my clients You might want to slow your level of physical accumulation if you're a buyer, but you don't want to stop, because even though it could come down, we're sitting above 4,500. I believe we could see $5,000 by the end of the year or sooner. And that's not that much of a stretch. In fact, if gold and silver perform 50% of the gains they did last year, that is actually a walk in the park. That would be achievable and not turn anybody's eyes going, wow, we did not expect this.
Yeah, that's a good point. Okay, well then let's first get to those price action just on silver again, because I just got to ask you, I mean, we need a kind of a grounded playbook because we're not on air next week and we still have 4 more days of rebalancing flow ahead. Forget intraday noise. Give us kind of that wide ranges that matter.
The most revealing part here isn't the $5,000 target. It's the admission that timing discipline has been completely overridden by momentum. As Gary Wagner highlights early in this segment, price behavior without corrections signals excess demand, not healthy balance, and history shows that matters. Gold gained roughly 13% last year, and even a 6 to 7% follow-through would statistically align with late-cycle trend extensions rather than parabolic blow-offs. The FOMO he describes isn't retail-driven hype. It's systematic flows chasing performance benchmarks ahead of quarter-end rebalancing. Investors should hear the caution beneath the optimism. Slowing accumulation is risk management, not bearishness. What Gary Wagner hints at next reframes how wide-range levels quietly dictate survival in momentum markets.
If we dip, what's the buy zone? Is it 72 to 74?
Absolutely. As long as silver stays above 71, you're solid.
Yeah.
That's the area that you want to look at. That is the series of bottoms that came in through December. The same with gold, as long as it remains above 4,300. If that maintains the price levels we see during the first quarter, expect the upside rallies to have a lot more energy than any kind of downside correction until it does come. In other words, we're bullish until we're not, till we're proven wrong. But price action has not proven a case that says we've seen any kind of a pivot from bullish to bearish.
Yeah. I mean, look at last year, Gary. I mean, you and I, since January, covering this gold move all year long, monthly, sometimes, bi-weekly at some points. Anything surprise you? I mean, everything, you were expecting a little bit of a dip here at some point. I guess that'll come before the 5,000 on the gold.
You would expect that. But if I expected a sizable correction last year, I would have been really wrong when you look at this market, because, even back in August, gold was at 3,400. And then it moves to 4,400.
Support levels sound boring, but they're where portfolios quietly live or die. Gary Wagner makes a critical distinction early on. Bullish doesn't mean reckless, it means conditional. Above 71 for silver and $4,300 for gold, the trend remains intact. Last year's move from $3,400 to $4,400 in gold wasn't fueled by economic strength, but by liquidity expectations and defensive allocation, which still haven't reversed. Investors should notice how upside energy consistently outweighs downside pressure, a hallmark of institutional accumulation rather than speculative churn. The risk isn't missing upside. It's assuming corrections must arrive on schedule. What Gary Wagner outlines next exposes why trend disbelief keeps fueling these rallies.
You get that $1,000 move in under a half a year. What we are witnessing is the intrinsic knowledge by large hedge funds, by speculators, that fiat currencies have no weight when weighed against or paired against a currency. Now, the US dollar has been the currency of choice for business transactions. It will continue to be.
A 1,000-point move in 6 months isn't enthusiasm. It's a verdict on credibility. Gary Wagner's observation points to something rarely said plainly. Capital is voting against fiat purchasing power, not for gold narratives. Hedge funds don't chase philosophy, they chase erosion. And global M2 growth plus persistent deficits make that erosion measurable. The dollar can remain dominant in transactions while still losing real value. Those ideas aren't mutually exclusive, despite media framing. Investors should recognize this as a structural hedge, not a trade driven by balance sheet reality rather than headlines.